Thanks, Julie.
Thank you for joining us this morning, and welcome to AFP's webinar on tax and the company car. I'm delighted to introduce myself, Julie Summerall, as AFP Director and your host for today. My colleague, James Pestle, who's also an AFP Director, and Paul Hollick, AFP Chairman. Our presenters today are David Chambers and Harvey Perkins from HRUX. Before we begin the presentation, I'd like to advise you that we will be recording this webinar to allow members to review the content at a later stage, and we'll have a Q&A session at the end following the presentations. As I said, the topic for our presentation today is tax and the company car, including excellent year-end tips. Over to you, Dave and Harvey.
Thank you, Julie, and good morning. And it's David Chandler, not Chambers, but that's fine.
Sorry.
It's okay. Good morning. Thank you all for joining. Yeah, as Julie said, we're going to be covering company cars and tax. I hope you can enjoy the picture. We were thinking it could be the last ICE company car driving off into the sunset after being taxed out of existence. But I'm not here to provide some wistful recollection of company car tax or why HMRC don't like Euro 6 diesels, some personal opinions. So what I, along with my colleague Harvey Perkins, are going to provide some hopefully insightful guidance to the company car rules, everything around them. Given we only have 30 minutes, for this session, and then we do have some time for questions, as Julie mentioned. We haven't quite got death by PowerPoint, but we do have a large number of slides. So just moving on, the first one just to mention, as I said, we're not going to be death by PowerPoint or death by tax rules, but we do want to try and make it a little bit more interesting and relevant, and try and keep the subject more lighthearted. Obviously not 30 minutes of tax. But do bear in mind we're tax advisors, so our definition of fun might differ slightly from yours. But first up, just a statement. So Moore's Law was a prediction made in 1965. And you can read it on screen, but essentially it states that the number of transistors per chip doubles every 2 years in technology, but the price of computer halves. So back in 65, he recognized that performance increases, but we pay less. So what? Well, audience members, you're the first to hear the Chandler supposition, which seems to state that the UK company car tax increases in complexity in the same proportion to the number of transistors on a microchip. And the cost of compliance is going to double every few years, and this too is going to be exponential. What I'm saying is car tax is so difficult now that in 4 years' time, you'll find it easier to land the space shuttle Perseverance on the surface of Mars than calculate the car on a company car tax. It's a nightmare, and we're going to come on and explain why that is. So who are we? So next slide, please, James. Thank you. So who are we? So yeah, I'm David Chandler. Worked for Big Four for many years, KPMG tax qualified and latterly EY, implementing some of the biggest car schemes in the country and advising corporates of all sizes. Very, very boring. My colleague Harvey Perkins created and ran 3 of the biggest company car teams in large accounting firms, including KPMG, where I worked closely with him. Some of you might be asking why I'm still working with him after 20 years, but we don't have long enough to explain that one. We now run our own firm, HRUX, and have done for, I think, 5 years now. And we're doing very similar things all around cars, technology, tax, etc., but without the hamstring of auditor rotation, which is great for us. So what are we going to cover today? So next slide, please. Very high level. So the rules to set the scene about why this subject is important to us. So a couple of slides about numbers, stats, etc. Well, you know, what is it that's so fascinating about cars? Why is it important to all of us? Why have we all joined to listen to this today? Brief session on things like private fuel. Unbelievably, people still have the benefit of private fuel. I actually reviewed some numbers for a client yesterday, and 15% of their employees still took it. All things EV, any talk about company cars right now would not be complete without looking at the EVs, where we are on the EVs, and actually how that indicates within salary sacrifice and what that means, and the attractions that's having. Then we're going to cover, we called it What's New Pussycat. So, the things like the super deduction, what's new in the budget, there wasn't a lot. And then the real boring stuff, which is the year-end compliance. We've left that for the end, so I'll probably run out of time. But starting, Harvey, I believe you have some stats for us.
Thank you, David. So we've got 4 slides of stats for you. We love this stuff. I appreciate not everybody will, but we've got loads of it. We just want 4 quick slides to try and position the company car market for you. The first one is drawn from data released by HMRC every year, and it just shows you the number of company cars that are reported on forms P11D. And the little yellow bar there is the total income tax paid by all of the people who have a company car reported on P11D. The orange bit is the national insurance, and the blue line is the total number of company cars reported on P11Ds. And what you can see, particularly over the last 4 to 5 years, is that the number of cars reported has been declining quite sharply, whilst the total tax and national insurance has been increasing. And in total for 18-19, although these are still provisional numbers, it's about 2.5 billion in tax and NIC earned on 870,000 company cars. What's going to happen with that next? Well, no one's really sure. We know that take-up of electric cars is very high, but we also know that the tax and national insurance on electric cars is very low. For last year, the tax and national insurance on a full electric was 0. So we suspect that the revenues, £2.5 billion, is going to evaporate very, very quickly. The next slide, please, shows you the same stats, but for people who take fuel as a benefit in a company car, so private fuel benefit. And what you can see there is that the rate at which people who take the benefit have been opting out is so high that although the tax and national insurance rate has continued to increase, the total tax and national insurance HMRC are making is in decline. There's an actual thing here, there's an actual effect called the Laffer curve that says that once you tax something beyond a certain point, people stop doing it, and your total tax and national insurance take will reduce, not increase. And we certainly think that's where the company car tax on ICE company cars is going. So the rates get higher, but the government don't necessarily make more money because people opt out or they take an electric car. Electric cars are fascinating. David, you were going to say something.
Yeah, no, I was just going to add the one thing to add, because people might say, why have we only got stats up to 18-19? And it's probably just worth adding, these are the latest stats that the government have, and this is how they base their decisions and stuff on. Obviously, people like the BVRLA and other bodies, etc., come up with more timely data, but in terms of the P11Ds and the tax take and all of that, this is the latest data they have.
Fantastic, thank you. The next slide is really interesting because it just looks at EVs and the growth in EVs and where in the world those cars sit. So you can see that in 2020, there was a total of 3.24 million EVs registered around the world, and 1.3 million of those were in China. So China has historically had more than half of the EVs in the world each year. But in 2020, that stopped being the case because of huge growth in the number of EVs that were taken in Europe. So if you look there for the figure, for instance, for Germany, which is 398,000 EVs and PHEVs taken last year, that's more than the United States, which took 328,000 EVs. So it's interesting to see who is taking EVs and to speculate as to where cars will go in the future. So for instance, under Biden, will we see a huge uptake in EVs in the US, maybe redressing some of that balance? Overall, EVs accounted for 4.2% of all of the cars that were built in the world in 2020. So it's still quite a small proportion, but you can see it's nearly doubled year on year. How long that rate of increase will continue, we don't know, because there are question marks over some of the materials used to make batteries. And although you'll read wildly differing opinions on LinkedIn between those who think there isn't an issue and those that think there is an issue, there does seem to be a sense that there's a capacity limit in terms of the number of EVs we can make globally in a year. The final slide of these 4 is the same numbers just for the UK. So this is 17, 18, 19, 20. And it shows you diesels, petrols, PHEVs, self-charging EVs, which is the yellow ones, and full battery electric vehicles. So you can see that battery electric vehicles grew to 6.6% of the total for 2020. Two main observations here. One is that the EVs, the HEVs and the PHEVs, their share of the market has grown dramatically in 2020. Second observation is the total number of cars registered in 2020 was down hugely on earlier years for reasons that we'll all understand. And the final observation is look at the numbers on diesels there at the bottom. So they've gone from being nearly half the market to being only slightly more than the total BEV, EV and PHEV. And I know figures for 2021 that we're already seeing would suggest that the electric cars are now supplanting diesel cars in that position. So those are just some stats on the market and where we sit. Next slide, please. So company cars, internal combustion engines. Obviously, the vast majority of company cars are still internal combustion engines, although the rate of change to EV is now pronounced. Why is that? Well, if you look at the tax charge is based upon a percentage of the list price of the vehicle. And broadly speaking, we think that any charge below 20% of the list price of the vehicle is reasonable. So we've color coded that green. Any charge between 20 and 30% of the list price of the vehicle is high. So we've color coded that amber. And any charge in excess of 30% is very high, which is why we've color coded that red. And if you go back to 15, 16, you were in that 20% band up to 110 grams. The red band started at 160. 16, 17, the green band comes in at 100 grams. 17, 18, 76 grams. 18, 19, 51 grams. 19, 20, all ICE cars were charged at 20 or 30%. And by 2021, the red band, so your car's taxed at more than 30% of the list price of the vehicle per annum, comes in at 95 grams. Now, if we go to the next slide, what we'll do is we'll overlay on top of that the CO2 emissions for a typical Passat. So we've just taken a typical diesel engined Passat. And you can see that in 15, 16, that car was well in the green band. 16, 17, still just in the green band. 17, 18, it had moved into the yellow band. 18, 19, not only did the yellow band start earlier, but the car was remeasured for CO2 emissions under NEDC correlated, and its CO2 emissions actually went up. So if you bought a new one, you were well into the yellow band, the 20% to 30% band. 1920, you're just short of the red band. 2021, we moved to WLTP. The CO2 emissions of that car are again recalculated, and boom, it's over 35% of the list price of the vehicle. So very, very quickly, what you can see is in just 6 years, it's moved from being really quite a benevolent tax rate to doubling, effectively becoming a very high tax rate for what is essentially the same benefit. In this case, a Euro 6D diesel. Next slide, please.
Cool, thank you, Harvey. So we just wanted to cover private fuel. So most of you, again, will understand how the tax calc works. It's simply the fuel scale charge times CO2 percentage. So if we just go on to the next slide, in terms of the calculation, the one thing to bear in mind is that the fuel scale charge is an arbitrary figure. It was created back in 2002, 2003. I think government came up with, or the revenue came up with that figure. So that's increased with RPI every year. So that's increasing, and over 20 years, that's increased. And the CO2 percentage has also increased, as Harvey just covered. So what does that mean for us and the numbers? Well, effectively, the graph on the screen shows us the value of the fuel that an employee is getting and the tax charge that they will be having. And we're looking at, again, the VW Passat, 34% scale charge, etc. And what the graph shows is that you, as an employee, and this is only looking at the employee's point of view, not the employer's point of view. And looking at the employer's point of view, will add other costs because they've got to pay for the fuel and the associated Class 1A. But looking at it from an employee's point of view, they need to be doing at least 30,000 miles, private miles, before it makes even a semblance of financial sense to the employee. Now, majority of people, well, especially in the last year, won't be doing anything near that. But even though you might have people doing that, for it to make financial sense, if an employer is paying it, you'd need to be doing about 60 to 70,000. That's not even on the graph. What's happened over the last 10 years, back to the graph which Harvey showed at the start, that benefit has been sort of stopped being provided by a lot of companies, whether that's through removing the fuel card or buying out the fuel card is, up to the employer in place. But most people have been buying out that benefit. Give the employee a small amount of cash, take the fuel card away, or get a reimbursement of private fuel methodology. And it's usually a win-win because the employee will pay less tax and the employer will make cost savings. It's a no-brainer, and I'm surprised some people still have the benefit of private fuel. That's all I want to say on that. Next slide, please. So we wanted to go on to talk about a little bit about the electrics and plugins. So again, the next slide just shows the what the current rates are, because if it wasn't complicated enough back a few years back, from 6th of April 2020, the government introduced a new table. Well, actually, they introduced two new tables because of the NEDC movement to WLTP. But this table is for vehicles registered post 6th of April 2020 with a comparison to 1920, just to show. So now we're in 21-22. EVs are 1%, still massively green zone, very, very low, which is why a lot of people are moving towards it. FEVs obviously have their rating based on the zero emission range of that vehicle. So how far can it go on an electric charge? We will talk more about the ZER range, so the zero emission range, in due course, because obviously you're going to need that for if you're payrolling your cars or when you do the P11D. But we've got that, we picked that up as part of the P11D. But suffice to say that now under the WOTP, the ZER can be a tad difficult to obtain because it isn't on the V5 document. Next slide, please. As I'm conscious of time, this is a slide that we've put together to just show a graphical representation for the choice that an employee might have for company cars and fleets right now. And I'm not here to recommend or not recommend Skodas, but they have a good range, which is why we've included a few of those. So what we have is, start with the Skoda Superb, diesel, bog standard, but 144 grams per kilometre. So that car has got a massive tax charge associated with it now. Firmly in the red zone, it's over nearly £4,500 tax for a high rate taxpayer. Skoda Octavia, less list price, lower CO2, but still actually a very high number, nearly £300 a month that individual will be paying. We've included a Toyota Prius. I know a lot of people have issues with the terminology self-charger, but these cars are quite efficient from an emissions perspective. But again, they don't really get much of a tax break. So you're still paying over £200 a month for that car. Then moving down, we have the FEVs, Skoda Superb Estate FEV and the Octavia FEV. And then you're starting getting into, man, these cars are so efficient from a tax perspective. Now, practical considerations obviously still remain. Do people charge them? Are they just driving around in a very heavy car and obviously having a large low MPG because they're not charging them up properly, not using them properly? Paul may have some comments on that at the end in the FAQs. And then we have the EVs. And a lot of people, once we get back to the office, will spend more in Costa and Starbucks than in tax on the EVs because they are just so attractive right now. Again, there are practical issues and considerations people need to think about, but purely from a tax perspective, it just shows why a lot of people are moving towards FEVs especially, and obviously to EVs. The tax, as it says there, the tax charge is 97% less for the ENIAC than the diesel, which is just crazy, but fantastic. And that's what's driving the behavior of employees right now. Next slide, please. Harvey, you're just going to cover salary sacrifice and the link in with what the choices are for people.
Absolutely, I'll do that. So if the tax charge on the Skoda Enyaq is so low, why would you pay tax on salary when you could have a company car? Seems bizarre, doesn't it, to put it in those terms when we spent so long talking about people opting out of company cars for cash. But we're now in a situation where some people are considering opting back in for a company car because they'll pay next to no tax on the benefit of the car. And of course, they'll save tax potentially at 40 or even 45% and NIC on their salaries. So we just wanted to have a quick look at salary sacrifice because we know a lot of businesses are looking at this. I'd say this is one of the biggest subjects that people want to talk to us about at the moment. So next slide, please. So 4 things just to note about salary sacrifice. The first is the employees giving up a contractual entitlement to their salary. It's not a deduction from pay. They actually agreed to a change in terms and conditions, which means they've given up their entitlement to something in return for something else. Second point, the gross income sacrifice reduces the employer's income tax, NIC liability, and the employer's NIC liability. So in effect, you're paying for the vehicle out of your gross pay, not your net pay. And if you've read any of my posts on how much tax and national insurance we actually pay as a nation, you'll know that can be a very, very substantial saving. Next point, it only works if the car emits 75 grams or less. So it won't work for a traditional company car, but it will work for anything that's electric or plug-in electric hybrid. And the final point to make, it can be against the full cost of the car, or you could use it as a contribution. So for the sake of argument, imagine someone's entitled to spend £300 a month on a company car under your scheme, and they want an EV, but the EV's £400. Well, you could take the sacrifice for that extra 100. So effectively, they're making a contribution towards the cost of the vehicle by way of giving up some of their salary. But that works for them because they're moving from something on which they might pay £400 a month in company car tax to something where they might only pay 10. So you can see it as the full cost of the car or just a contribution towards the full cost of the car, depending on entitlement. So if we go to the next one, please, just very, very quickly. Yes, the i3 is my favorite electric car because I think they're nice, but I know they're a bit Marmite. How does the sacrifice work? Very, very simply, £6,041 is written top of the left-hand column. That's the amount of money that we think it will cost for you to go out and get one of these. So that's rental, maintenance, insurance, potentially ETI insurance as well. That is the amount that the employer needs. So they say to the employee, hey, if you give up your contractual entitlement to £6,000, you can have one of these. So the employee says, yes, fine, and immediately makes a saving of £2,300. That's because they've saved income tax and national insurance. They will have to pay company car tax, but we've already established it's sod all. So that leaves the employee with net 3,739, and that's only £300 a month. From the employer's perspective, they've not had to pay £6,000 in salary and have provided the company car instead, which costs them £6,000. However, they don't have to pay national insurance on that salary, so they save £753. There is some national insurance to pay on the company car, but again, for all the reasons we've already given, it's next to nothing. So the employee has got a car for £312 a month, and the employer has saved £753, which of course the employer could give back to the employee if they chose to do so. So we've assumed they've kept it, but of course they could share it. That's just one car. Let's look at a whole bunch of cars. So these are all different cars. Obviously, some of them are EVs, some of them are PHEVs. The first car there is that BMW i3 that we've already talked about. So you can see halfway down the column on the left-hand side, it says 312. Remember, that was the cost to the employee of having that as a company car. We think if they went out and leased that one, personal contract hire, maintenance, insurance, etc., it would be 537. So they've saved £225 by having that as a company car rather than getting the salary and going out and spending it in a dealership on a personal lease. So that's massive, isn't it? That's a huge saving for an individual. Just reading across there, we think you can have a mini electric S1 for 290 quid. A VW Passat for 599. So why is that so much more? Because it's a plug-in electric hybrid. So the tax liability on that isn't 15 or 20 pounds, it's 149. You can see it in sort of halfway up the column there. So there's a saving on the PHEV, but it's nowhere near as good as it is on the EVs. And that's true also of the BMW 330e, which, to judge from the number of them that I see on the roads at the moment, must be one of the best-selling company cars in the country. But even on that, there is a saving under this scheme, but the saving is less because it's not a full EV. Contrast that to the Tesla next to it, more or less the same list price. You can run that one for £447 a month under salary sacrifice. Audi e-tron 548, Tesla S 785. You can have a Porsche Taycan Turbo, that's the 140 grand one, for £1,300. And if you think that's out of most people's reach, what you will find is there's a lot of SMEs where the managing director is looking at something like this. Once upon a time, managing directors of small companies ran Range Rovers. I think you'll find that they're all going to be in Porsche Taycans or similar as time passes. because the saving on that car is £986 a month, which is pretty attractive. I think we can all agree. Next slide, please. So some maths, really, really simple. We're going to compare the cost of a Skoda Octavia as a company car, which is the first two columns. So the blue bit is how much it costs the company to provide. The orange bit is the national insurance. The grey bit is how much the employer will pay in income tax. So it's going to cost the employer £22,000 to give the employee a benefit on which they'll pay tax of just under 10 grand, 9,874. If we convert it to a cash option, but we equalize the employee, so the employee will still have to find 9,874, then the employer's cost falls to 13,199. And this is why cash allowances are so attractive for people who want to run a petrol or a diesel vehicle. Obviously, the employee doesn't have to put in as much as 9,874. If they put less in, then the employer's cost will be higher. But the point is those two columns together are still less than the cost of running as a company car. But then let's compare it to the Skoda Enyaq. So the Enyaq cost a little bit more. So you can see the employer's cost, the blue bit, is higher, but the national insurance is next to nothing. So overall, the Enyaq costs the employer less to provide than the Skoda Octavia diesel. But look at the employee's position. Instead of paying the next to £10,000, they're going to pay 681. So where does sacrifice come in? Well, let's do a couple of things. The first thing we're going to do is we're going to say the employee is going to make a salary sacrifice so that the cost to them is the same as if they had a diesel company car. So they're still putting in 9,874, but most of that is salary sacrifice. But look at the cost to the employer. It's fallen to 6,818. It's much, much lower, the lowest on the page. Now, is it reasonable to expect the employee to sacrifice that much? Probably not. So let's say that they only sacrifice £2,000 a year. Press the button, that's it. So then we've got a cost to the employer of 6,681. So they've saved money and the employer's costs are down to 12,000. So you can see that if we introduce a sacrifice, we're reducing the employer's cost because although they're still paying for the car, they're paying less salary to the employee. And we're modifying the amount that the employee puts into the equation. If we go one more time, what we've done now is to say, well, the employer is not going to put anything in. So this is an employee who doesn't have an entitlement. The employer doesn't want to pay anything towards the cost of the car. They want the sacrifice to be complete, which is the scenario we talked about on the I3 earlier. So the cost to the employee is 16,705 and the cost to the employer is 0. So can you see how you can use sacrifice to alter the balance between employer and employee to drive whatever the HR outcome is that you want? Next slide, please. Just checking, that is one of mine. So what's new?
It is. This is when you're supposed to do the Tom Jones introduction.
This is. Do you want me to sing the song?
No, the audience definitely don't.
Can we go to the next slide, please? So we're going to talk about 4 things. We're going to talk about the EV grant. We're going to talk about the super deduction. We're going to talk about the other things that have changed, and we're going to put some global perspective around that. And David and I will do this together. So we're going to start by talking about the EV grant, the grant that wasn't. So we go to the next slide. So I've headed this up, taking grants for granted. Because here's the thing about the grant has been cut. It used to come on all vehicles. I mean, it's changed a couple of times over the years, but until a couple of weeks ago, it came on all electric vehicles under £50,000, and that's been cut to 35. And the grant itself has been cut from 3 to 2,500. And as Katrina's just pointed out, with no notice. And there's all sorts of reasons why the government have done that. But again, if you follow me on LinkedIn, you'll see that I didn't approve of it personally, and I wrote several posts about why I thought it was a bad idea. But here's the main reason I think it's a bad idea. They're not actually giving you anything. Even when you get a grant, you haven't actually got anything because you're still paying VAT on the car. The grant is a reduction in the tax take on the car. You're not getting anything back, you're paying less. So if you look at the ID3, the first car, the £32,000 ID3, and I do get that some list prices are now being changed by manufacturers to come back within the grant. This was all put together before those announcements. That £32,000 car, that still gets a grant. So the VAT on that car is 5,800. You take off your grant 2,500, you are still giving the government £3,319, which is 9.5% of the list price of the vehicle. So you're still making a contribution. The direction of travel of the money flow is from you to the government. It's just that they're willing to only take 10% on this ID3. On the Tech Pro Performance, I'm still getting used to all of the names for these cars, but on the Tech Pro Performance, which is the higher battery, that becomes 16.6%. Because the government are taking £6,574 because there is no longer a grant on that vehicle. And you'll see that 6574 is the highest number on this page because the ID3 Tech Pro Performance is the most expensive car on this page because of the technology in it. Arguably, all four of these cars do pretty much the same job. The diesel, the last car, the VW Golf, the diesel engine car that the government don't want you to have, they're willing to live with just 4,799 in VAT on that vehicle. So I know in percentage terms it's the highest because of the vehicle excise duty, but the point is that for cars of similar capability, they're taking more on the electric car than they're taking on the diesel. And that was what we thought the grant was for. We thought the grant was to help counter the fact that the electric car costs more because of the technology in it, but that's what government want you to take. Super deduction.
Cool. So the super deduction, is it a bird, is it a plane? No, it's a super deduction. So this was announced in the budget 2021, this new super deduction of 130%. As with anything to do with the tax rules, there's lots of complexity behind the scenes. So it wasn't quite simple. It's due for, they announced it for 2 years, due to cover expenditure between April 2021 and March 23. And it's only available for tax relief against corporation tax, so obviously for incorporated businesses. What it allows, the deduction, what it allows you to do is for companies to claim capital allowances of 130% the cost of any qualifying expenditure. Which, if you look at it, so what does that mean actually from a cost perspective? So every £100 you invest in expenditure, you will get a reduction of £24.70. Because it's for qualifying reduction, you get CT relief. That CT relief is then made 130%. So obviously that makes it very attractive. The issue we have, if you just go down one, please. The issue we have is there are a number of restrictions. Okay, now firstly, positive, no cap on the investment. Fantastic. It is only available for new assets, so not second-hand. And those assets that are then held for leasing, it's also not allowed for. We have said that cars are excluded, but vans are not. Essentially what the legislation states is that it will apply to all plant and machinery unless it's covered by an exclusion. Cars have specific legislation written for it around what the capital allowances are. So because they have that, it's not allowable for them. But vans don't. So actually, if you're not going to be leasing those vans, as you're just going to get them, then absolutely you will be allowed to have that super deduction. The other thing to bear in mind is that there's no actual statutory definition of plant. So most of the legislation is sort of about 10 centimeters big, and there's about 6 books of them. So it's very, very detailed. But within corporation tax and capital allowances, there is no statutory definition. So you have to look at what's found in case law and guidance. And there is lots of guidance, but the government or the revenue really take a little bit of time to get their formal guidance out. So the legislation only came out in March with their notes, but we haven't had the formal guidance yet. So initial thoughts about would be included to do with charge points are that actually would charge points apply? Yes, they would. The problem we have is that actually are charge points classified as plant or are they classified as fixtures? And if they're classified as fixtures, they're only allowable for the 50% first year allowance. But if they're classified as plant, they would be allowed the full 130% deduction. And Paul tries to nail me to a cross and say, yeah, but which one is it? And I can't sit there and tell you it's one or the other because it's not written down in black and white in the legislation. Now we're hopeful because people are now lobbying the government to say, well, is it included? Is the groundwork included? Are the cables included? So we would hope in the next few months, the revenue will issue guidance and explain what is included and what isn't included, which will hopefully answer probably a lot of the questions which people might ask us in 20 minutes. Next slide, please. So another little complexity around what happens if you just go through and produce the next bit. Another complexity is actually that you need to think about is what happens from a practical perspective if you're going to then go and claim that. So I thought the best way to do that is look at an example. So if you buy a van for 20,000 and you get a super deduction for it, that's worth £4,940 for you, which is fantastic. So it makes it a little bit more worthwhile than it was, say, 3 months ago. However, there is an implication on when you then sell that asset. And where the disposal, as long as it happens after 2023 from an accounting period perspective, because again, there's complexity regarding that. What you have to do is when you sell the asset, you then have to apply the 130% uplift. So and on top of that, you need to bear in mind that the corporation tax is increasing to 25%. Again, thanks to the government back in March. Again, so lots of complexity. We're back to this Chandler supposition. So if I sold the van in 4 years for, say, £10,000, you would actually not just have to pay tax on the 19% or the 25%, you'd have to uplift that 25% to the 130%. So actually the charge would be 3,250. So there's an accompanying charge which comes later down the line. So again, it's just something to be aware of if you are then taking that super deduction.
And just to add, there's going to be a requirement that you retain records so that you can prove that you've done all of this. And on top of that, there's going to be anti-avoidance legislation. And, you know, we made this point at the beginning, and it is a tax joke, the point about the Chandler supposition, but we have seen this so many times in our careers. So you see a simple announcement that on the face of it is just extremely positive, and this is positive. But by the time they finish writing legislation and guidance and anti-avoidance provisions, it will add up to tens and tens, if not hundreds of pages of material that all needs to be read and understood to make sure that you qualify for all of it on everything that you spend, with a million exceptions. And this is the way it is with company cars and, frankly, tax in the UK. That there's going to be a lot of hassle here to get this right.
Thanks, Harvey, for adding that. If we go on to the next slide, please. Conscious we're nearly through most of the slides. And I know, so a couple of the questions I saw, are we sharing the slides? Yes, we are, but what we want to do with the slides is leave you with as much information as possible so that actually you can come back and look at them. Legislation changes. My notes for this says very boring, move on. There's an update on that. Everyone probably knows of these. If you have questions on it, let us know afterwards. Next slide, please. Global perspective, again, we just wanted to mention a couple of these points because although the tax rules are the tax rules, which is great, there's lots of other stuff which is happening around the outskirts of that as well. So obviously we all know about the ban on the sale of diesel and petrol, and that's due to come in at 2030. FEVs obviously will let a small 5-year window that we can still sell those for new ones. We've got the road to zero, which is the government investing in infrastructure. Every year they continually invest. There's more chargers coming, quicker chargers, superchargers, etc. We've got the EV100, which is obviously as a group of companies coming together to make that move to EVs quicker and be the early adopters, which is obviously great for EVs. It obviously can then be show how companies can do it quickly and easily. And lastly is the clean air zones. And obviously this is just something that, again, the government have insisted that every local authority have to have a policy about how they set their minimum emission levels in all of the regions around the UK. Some bodies are further forward than others, and some are now introducing their standards on whether they're charging or whether they're insisting that cars can't go in certain zones, etc. But every authority has something slightly different around that. One of the questions, again, and again, I know we'll pick this up, but have asked around what do other countries do? Other countries do have rules around salary sacrifice, enthusiasm around EVs, etc. And one of the ones which, when Harvey went through the countries earlier, Norway has been is held up as a shining example of how to get involvement into EVs, but they have spent 20 years investing in EVs, infrastructure, low tax rates for those cars. Lots of the Nordic regions have salary sacrifice for low emitting cars. Not all of the countries in Europe do, and it does just depend on what each individual country wants to do. But there are lots of examples of countries that do have salary sacrifice and do have focus and enthusiasm to bring EVs quicker to market. Next slide, please. Last couple. So year-end reporting. So again, these are probably the quite boring bits. If we just squeeze through these, a couple of headlines just to pull out. Deadlines for P11Ds, 6th of July. To pay the Class 1A due 19th or 22nd of July if you're paying electronically. Again, can we just bring up the rest of the slides, please, James? The rest of the, there we go. So in terms of most people will be aware of the process. You need to collect the data, review the data, prepare the P11Ds, and then send them out, finalise and send them out. There are penalties for incorrect forms. There are penalties for late forms. The one thing to just comment on as well is there will be no extension due to COVID, or there is not expected to be an extension due to COVID. Some of the tax deadlines had extensions. This is not expected to have one of them. So we need to get it right, need to get it done on time. Next slide, please. Back to the China supposition. This year, P11Ds are going to be very complicated. To try and simplify it, the only fuel types you can report on a P11D this year are F, D, or A. So all of the comments that Harvey made earlier and I've made earlier about, is it a diesel? Is it a Euro 6? Is it a mild hybrid? Is it a FEV? Is it electric? Doesn't matter. It's an F, a D, or an A. That's it. That's the only things that will be allowed on the form. F is for Euro 6 compliant diesels. D is for diesels. And A is for everything else. The thing to bear in mind is that for it to be a D or an F, it needs to be propelled solely by diesel. So a mild hybrid is not a diesel because there's an electric drivetrain behind it, so it would go under A. Because the issue is a mild hybrid isn't an RDE2 compliant car. And if you put it under D, it will get the 4% surcharge, and F doesn't get the 4% surcharge. For those vehicles, for the FEVs, for those vehicles that are less than 51 grams per kilometre, you need to use the zero emission range. I mentioned earlier, the only place you can get the zero emission range under WLTP is on what's called the certificate of conformity. The certificate of conformity is a piece of paper which gets delivered with the vehicle. It is not on the V5, and then it's down to, say, the manufacturer or the leasing company that get that car to either put that information onto a system or provide that information to clients. The HMRC advice, which was an employer bulletin that came out in February, is that employers should be able to get their information from manufacturers or from leasing companies. So we're starting to have conversations with people already about how you're going to get that information. Because when you get to the 5th of July, you don't want to be scrabbling around for the ZER for any FEVs.
Just to be fair, David, the bulletin says you should be able to get that from the manufacturer or the leasing company, but there's no obligation on the manufacturer or the leasing company to provide under the tax laws. It's the employers, the onus is on the employer to report the correct number. So the revenue use words like should, but it's not like you can say to the revenue, well, they won't give it to me. The revenue will say, well, that's your problem.
Yeah, and then just the other comment that's not on here, just to bear in mind, is Opera is still in existence for cars above 75 grams. So majority of cars nowadays, if you offer a cash allowance, the majority of cars are higher than the cash allowance, but it is just something to bear in mind. You still need to do that comparison. Final slide, please. It's just a mention, and then again, please, James, yeah, just go through. Wanted to mention P87 because, again, some companies aren't necessarily aware of what this is. This is for people who are not in a company car, but for employees who are doing business mileage in their own cars. Current rates 45p and 25p. The revenue or the government have made the process for P87 much, much simpler now. You can do it by post, by phone, or on the online account if they have an online account. You do need to take care when submitting it, but it is possible to make the P87 claims for anyone that does business mileage that doesn't get reimbursed at those AMAP rates. So if you provide reimbursement to people in their own cars at, say, the advisory fuel rates, 15p, 13p, etc., the employees can go and make a claim. And some companies help those employees by providing reports. Something to bear in mind, because obviously everybody likes a little bit of tax relief if they can get some at the end of the year. That ends the boring bits. Next slide is then any questions. Julie, I think you were going to bring in Paul, weren't you? And then
That's right.
Ask us the questions.
Yeah, thanks again, both. That's been really interesting, and thank you for keeping it so light and understanding as well. We have received a number of questions. I'll kick off with the first one, and this is to you, David. With tax take from fuel reducing as fleets migrate to BEVs, where do you see BIK rates post 2025?
So it's a great question. So the fuel take is currently about £33 billion. The company car take is about or just under 3 billion. So it's a big number. Combined, it's a big number. The only way I can see it going is road charging. For the company car tax, 3 billion. So the government bring in about, I think the number varies depending on which year, but it's around 800 billion pounds from the suite of taxes. So for 3 billion pounds is not a big number in the grand scheme of things. So they can move stuff around in terms of from anything to find 3 billion. But 33 billion, the fuel duty, half of that is from cars, half of that is from HGVs, etc. So they're big numbers. So they have to do something. They've got 3, 4, 5 years. And part of the consultations they're now looking at is, can they do road charging? How would road charging work? So I can see that I would expect road charging at some point in the future to be a more serious route of taxation.
I think, Julie, just to add on that as well, from our perspective as the AFP, obviously we do expect road tolling to probably come in the second half of the decade, because we've now got tax tables only until 24. We've not had any advice about extra years. Obviously, there's some great benefits still for electric vehicles at 2% right up until 24. But we really want to see the tax tables for the second half of the decade. But I think the reason we're not seeing them at the moment is because of this broader discussion around road tolling.
And Paul, if I just pick up on it, because I know that one of the questions I saw, I think, when we were discussing this yesterday, is the tax tables have only been announced to 2023, but within the commentary associated, because one of the questions was, is it in statute in law yet? And the answer to that is no. They are a statute in law until 2023. And then there was a commentary on the association aside that, which said, and we won't increase the rates until, or there's an expectation the rates won't be increased until 2025. But I just want to mention that because the government do have form for, if it's not in legislation, they could change the rates. So we're not expecting them to change before 2025. But if EVs went mainstream quicker than that, they could easily increase those rates by a few percent. Now, it's not expected to get anywhere high, but there's just that concern that we do need to be mindful of.
Thank you all. Yeah, just sort of moving on in regards to sort of commercial vehicles, and there's been a lot of press about Coca-Cola recently. To the panel, what is your view on what is an LCV and what is a car? Anyone want to go at that one?
I can start, since most people will know it's a tax case. The revenue, the government haven't changed the rules. Okay, they haven't changed their guidance. They haven't changed the rules. They still say for a vehicle to be treated as commercial, the fundamental use of that vehicle, or the primary use of that vehicle, needs to be for the transference of goods. Okay, so if you're using it to transfer goods and to transfer people, then there is a secondary reason for you for that, and they will argue it's a car. I think that the problem nowadays is a lot of manufacturers have created vehicles that have a dual purpose. The revenue have not updated their guidance to reflect the fact that people can now manufacturers make vehicles that can be dual purpose. Where I tend to advise clients that where they have an element of doubt, go and get clearance on the revenue, because you can, if you generally put your position forward, then you do it on your basis while you're using the vehicles, and you can say yes, they're for goods, not for transferring people. So you could transfer people, but actually that's a minor issue. If you're going to be changing the vans fundamentally, I would ensure that real care is taken about why you're doing so. If you're putting seats into a van that doesn't have them, or you're putting windows into a van that doesn't have them, you'd need to take extreme care on those, because the revenue are quite hot on that now, following the Coca-Cola case. And I think they would argue those ones then are for transferring of people as well as goods.
I think this is the problem with the Coca-Cola case, is as soon as you modify a vehicle to put some seats in the back and some windows in the back, then suddenly you've got a challenge on your hands.
Yep.
So personally, I think you just need to think about, if it's got seats in the back and windows in the back for people to look out of, it's likely to be deemed by the revenue at the moment as a car.
I would say yes, but just to give you a good example, Paul, what happens if you're transferring, say, animals?
Yeah, totally.
So you might put windows in the back actually because they need it. So, and that's back to why you might want to go to HMRC to say, look, these are my circumstances. This is why we're amending the van.
I totally agree with
not
windows.
black and white.
Yeah, but I mean, as the revenue have come out and already said about the windows as well, which I do think
Yeah.
is a fun situation. But I agree, if you're transmitting or commuting other things other than humans, then I totally agree with you as well.
Yeah.
Okay, next question. Is there anything you think HMRC or the government could be doing differently about BIK and company cars? David, do you want to kick that one off?
Is there anything that, well, it annoys me about the time it takes for them to turn around the data, so they can do the data quicker, because then we can make rules on actually what's happening now. So that's just an easy one. I think they need to provide a bit more formal confirmation about what the rules are going to be 3, 4, 5 years in advance. So I mentioned the fact that yes, they've said they won't increase them, but actually they haven't given us that long-term clarity. Because they say, yeah, you know, the road to zero is all about how we move to EVs, but then the tax rules aren't given the same longevity, and I would like to see that. So, because a lot of people aren't moving to EVs now for commercial reasons. So, i.e., if a driver has to do 30,000 miles, the EV isn't going to be the right car. So they're still stuck in a diesel, which is paying 37%. If they give them longevity, actually, we know EVs are going to be here for the next 6 years at a very low tax rate. That then gives you comfort. So, like, we'll run diesels for 3 more years, then we're going to get into EVs, and then we can look at longevity. But we just don't know at the moment, and we don't have that. You know, people ask me about the crystal ball type thing. When are the tax rates going to increase? How much are they going to increase? And we just don't know. I don't know, Harvey, if you've got any sort of comment on what you think they might like to improve.
I know that Paul is going to come on and talk about the AFP Tax manifesto, and in a way, that's where we've written down what we'd like to see changed. But yes, I would agree with David. We would really like to understand more than 2 years in advance what's going to happen next, particularly when they do seem to make then quite rash decisions with very little warning. So we you know, given that you acquire a company car to run over 3 or even 4 years, it seems reasonable to us that you'd understand the treatment of that asset throughout its life from the employer and the employee perspective.
Yeah.
While we've got both of you guys on, I've been having a few questions on the panel already anyway, but can you just tell everybody on the that's viewing what the rules are for EV reimbursement payments when the employer or the employee are paying for the energy?
So for company cars, that's just I'm seeing a lot of things pop up, and we're trying to answer from a general perspective, but there's lots of detail behind lots of this stuff. You can get into it. But in terms of company cars, if you have a company car, obviously, if you're going to reimburse fuel, electricity is not considered a fuel by the revenue at the moment, by legislation at the moment. So what the revenue did 2 years ago, I think, was create the separate rate. So the AER, which is an electric rate, and they say it's 4p. So if someone drives business miles, while they're in their company EV, you can reimburse them at 4p a mile. Okay, that's a given. There was no tax consequences. You wouldn't have to get approval or anything like that. The other side of things then is like, from an EV perspective, we can come on and sort of talk about FEVs very briefly, Paul, because that's then another issue. If you wanted to reimburse the cost of the electricity, at the moment, the rules have said that you can reimburse. So if you charge them at work, there's no tax consequences of that. You can implement charges at home. There's no tax consequences for implementing those charges. But if, for instance, you went to a charging unit when you're out driving and you paid for that charging structure, that would then be if you paid for the, let's just say it was £20, you paid for that, there are tax implications of that because it's an amount. And that's where we get complexity. And that's why a lot of us are then lobbying the government to say, can we just have clarity on exactly how we do this? Because you can charge the car differently. There are so many different ways of charging it that we need clarity on what you can do and what you can't do.
So if we just tick them off one by one, then if an employee is allowing the employee with a company car to charge at work for all their trips, business and private, there's no tax.
Correct. No tax implications.
Okay. If an employer puts a home charging unit in and pays for all of that home charging unit cost for business and private, there is.
Again,
no cost.
the implication, the installation, there's no tax implications for that again.
Yeah, but all the energy, because the employer is paying for that energy at that charge point, then even though it's at the home, for business and private trips, is there a tax benefit?
I don't think so, no, currently, because that's the one. This is then you get into how do you say what was charged for private and what was charged for business.
Yeah. But then if the employee is paying for the home domestic energy and the employer pays for both the business and private trips, there is a taxable position for that. Yeah.
Correct. Again, so it's overly complicated that we need, and it all comes back to the fact that electricity is not a fuel, so it falls under different legislation in terms of how it's looked after.
And then if the employee is paying for their own EV highway payments, and then the employer is reimbursing them for everything, business and private, again, there's a taxable implication for that, for the private element.
Yeah, that's correct. And as someone's pointed out, if you're just reimbursing business miles, 4p per mile, simple. It's when you start reimbursing for either all miles or for the costs of electricity. If someone claims £20 of electricity, that's when it's difficult because you then can't allocate it's difficult to allocate what's business, what's private, etc.
Could I just chip in with another add-on to that point, really? In a recent Fleet News article, it was suggested that 4p per mile for EVs was not sufficient for real-world charging costs. Do you expect the 4p rate to be increased anytime soon?
I wouldn't expect the 4p rate to be increased. I would expect, hopefully, the revenue to issue more helpful guidance on how we deal with it. And you have to bear in mind, the AER, in the same way as the AFR, is a guide. So if you can prove that your reimbursement, your costs are, let's just say 8p, then you can do that. But if the revenue come in and review you when they do an employment tax review, they will come in, review and go, okay, well, how did you get that cost? As long as you can prove how you've got to that 8p, then that's absolutely fine. You are allowed to reimburse for business costs.
Yep. Look, from my view, from what I've seen as well, the cost per mile to charge a vehicle varies greatly. If you pay on a 16 pence per kilowatt cycle, then half of the UK available EVs will probably run at 4p, and the other half will be around 6p. But if you're using a smart meter type environment from Octopus or EDF or Centrica, where there's an overnight tariff, then that could drop down to 1-2 pence per mile for absolutely every single vehicle that you see in the UK. But then conversely, for those guys that don't have a driveway and can't put in a domestic home charging unit and they have to charge on the EV highway, then the charge cost per mile could go up as much as 10 or 11 pence per mile, depending on where they charge up as well. So the answer really is 4 pence per mile from an AFP perspective isn't ideal, but at least we've got a guide. I think some of the battleground is to try and encourage the employees to be smart with their home energy provision, if they do have that, and also for us to help and support the employees with their curbside charging as well as best we can, to try and make sure that it's as cost effective as possible when you're charging. No different than fuel in some respects, with supermarket fills over motorway fills as well.
I think the differences are just much greater, Paul. That's what we're dealing with. The other thing just to add as well is that we've talked there about company cars, not employee-owned cars. And when Harvey mentioned salary sacrifice earlier, if you go into a salary sacrifice scheme, that becomes a company car, not an employee-owned car. It's just a couple of the comments that came up on the chat.
Okay.
Interesting, actually, on that point. We've also had a comment about the reimbursement of PHEVs. Is there a view on that at all? Maybe more.
Apart from hideously complicated.
Yeah, that's what the comment said. Yes, exactly.
So the FEVs don't have a separate category, so you can only reimburse them at the AFR based on the engine size.
I would, sorry, David, I would also say that if you are running fuel cards on FEVs, particularly if they're doing high business miles, a lot of FEVs are running on the petrol engine predominantly over and above the electric cycle. I've seen from my day job, it's better to deduct all of the fuel card cost and then reimburse the employee at AFR rates rather than trying to do it at actual cost.
No, I agree with that. And at some companies, what they're doing as well is looking at back to the old triangular rule from years ago. So who's old enough will remember. And essentially removing your home to work commute from any reimbursement to encourage people to be charging the cars. Because the problem is if you just reimburse at AFR rates, there's no encouragement for people to charge those vehicles up. But if you chop off the first 20 miles of any claim, they're going to be charging them up.
Yeah, totally. There's no reason why you couldn't reimburse an employee for the first 20 miles at 4p and then the other 40 miles of a 60-mile trip at 13p or 11p.
It adds admin, but absolutely not. No.
Yeah.
Okay, so I think time's getting on, so we'll have one last question. Changing the subject totally, can you clarify the implications of the operation of a pool vehicle, car or van, as opposed to a company vehicle? Is that you again, David, to start?
A pool vehicle, that's a test. For a car to be treated as a pool vehicle, there are 5 things that have to happen, and I can't remember off the top of my head, but essentially they have to be used not by one employee at the restriction of everyone else. They shouldn't be taken home. They can be, but they shouldn't be on a regular basis. So if they're taken home, it's because you're going to a meeting the next morning, but not regularly. What are the others? They shouldn't be taken home just for security purposes. There are lots and lots of, as I say, there are 5 restrictions. They're quite clear in terms of how for the car to be treated as a pool car. If you do not meet those 5 restrictions, the revenue will say it's not a pool car, and you'll have to pay tax on it as a company car.
Okay.
And they've got a lot stricter over that.
The fundamental problem with cars, and this again is addressed in the AFP Tax Manifesto, but it's this concept of tax charges associated with the fact that the car is available for private use. It's not about using it privately, it's about the fact you could. So all of the rules around pool cars are designed to demonstrate that the employee hasn't got that availability. Now, you could argue that if the car is an electric car and you've got a 1% charge based on list price, pay the tax, it doesn't really matter. As David said earlier, you'll be spending more in Starbucks than you would on company car tax. But of course, as time passes, those rates will increase again. And if it's a diesel or a petrol, you definitely don't want to accidentally end up with the tax charge.
Mm-hmm.
So just
but
to cover
this is
quickly,
addressed in the manifesto. It's one of the points that the AFP is making, is that we should have more of a de minimis approach to what is private use than just saying availability. Sorry, David.
No, just pick. So it needs to be available and used by more than one employee. So if you only have one employee using it, it's not a pool car. It's made available by reason of employment. That's usually a tick, easily tick. It's not used to the exclusion of others by one person. Any private use is incidental to their business use. So that's i.e. you're taking it home because you're going to a meeting the next morning. Okay. And then it's not normally kept overnight on or near the residence of any employees, unless it's kept on premises occupied by the provider of the car. And if it fails any of those, then it's regarded as a shared car or shared vehicle, shared car. But back to the point which Harvey made, which is a really good one, the de minimis, because if you think about things like hire cars, which people might use, a hire car, if it's available for private use, which if you've kept it for more than one day is generally available for private use, is reportable as a company car. The tax on that might be a few pounds, but it's ludicrous to try and report that. So there should be some form of de minimis, but Paul might pick up on that as part of the manifesto.
Okay, all right, that's fabulous. I'd like to hand over to Paul now so he can launch the AFP Tax Manifesto. Thank you, Paul.
Thank you, Julie. Thank you guys for a very interesting Q&A session. So James, can I just go to the next slide, please? So just for the people on the webinar that aren't already AFP members, I'm sure the majority are, but just an overview of the AFP for you guys. So we are the industry body for fleet professionals, primarily fleet managers and fleet directors in the UK marketplace. The AFP, the Association of Fleet Professionals, we are very much committed to supporting our members. We've got helpline, admin centre to be able to deal with any of your questions and queries. So some of these questions, if you do have any direct questions for us or David or Harvey after this session, please get in touch with us via our website and we will be able to answer your questions directly. We are providing best practice documents and education for the fleet industry, particularly around fleet electrification. I know we've had a lot of questions in the Q&A session around electric vehicles, but we are aware that it is by far the biggest challenge for our members in terms of their journey for EV deployment. Some are further ahead than others on that deployment program, and we are here to support everybody in the UK on this journey. We are lobbying on the conditions we need as fleet operators. So we talked about the AER rate and the 4 pence today, and we are already engaged with HMRC and other industry bodies in terms of talking to the HMRC about what our requirements are as for us running national fleets. And of course, we're networking and connecting like-minded people together as well. We've got this program of 2021 webinars, which are free, open to all. So the next one will be in 2 months' time. If you're not a member, please join up. Individual packs start at £99. But today, and James, if you can just press the next slide for me, we will be launching our tax manifesto out into the marketplace. Now, this manifesto has come out of various committees that we are running. We've got about 45 fleet professionals across 5 committees. The 5 committees are EV, alt fuels and low carbon, LCV, future roads, risk compliance and health, and future mobility steering. The majority of these topics have come out of the future mobility steering and the EV committee. But there's a 13-point manifesto that we're releasing to the market today, which will be available on our website for you guys to download. Our website is www.theafp.co.uk, and it just demonstrates some of the conditions that we believe as UK fleet operators that we need in place from a tax perspective to really be able to help out with a few things. One is our electrification program, corporate electrification program across the UK. One is just support in terms of the deployment around clean air zones and what they look like and how we would nationally need to pay for the clean air zones as well. Some are around the resistance that we may have as we move forward with the future mobility concepts, so mobility as a service, particularly touching on one of the points around pool vehicles, around the HMRC ruling that if you make a car available to an employee for personal use, then it's taxable, which again creates some issues with pool vehicles, it creates some issues with COVID, but it also creates a load of issues when you're offering car clubs to employees, even if they are paying an equitable rate to rent that vehicle from you at arm's length. The manifesto includes our position on road tolling, car park costs, and parking, particularly at train stations, as being an overall form of the mass agenda and what we would like to see on that. And obviously some clear definition on our EV support. And we had some comments at the start of this webinar from some of you guys around the change in the grant overnight. And of course, we understand the reasons for that, but us running UK fleets, we really need to know what the grants are in place, how long they're going to be in place for, to be able to really set our total cost of ownership or whole life costs in the right way, to be able to get boards to sign off. What we don't want to see is vehicles to be out of band overnight because things have just changed. But we get the reasons why they have changed, of course, as well. And also we are happy in some regards that non-Euro 6 compliant diesels do pick up a fair share of tax as well. while that maybe supports the EV agenda even more as we look at these things. And of course, the biggest issue, I think, as well with EV deployment at the moment, particularly the ones that are spearheading this agenda, is curbside charging, and how national fleets can easily get curbside charging units set up for employees that don't have a driveway. So please download the document. It should be a good read. It's not a massive document either, and get behind us if you can as we try and improve the conditions for all of our members and anybody that's operating UK fleets nationally. Anyway, Julie, back to you.
Thank you, Paul. Thank you for all the questions. Apologies for those that we didn't manage to get through and answer in time today, but as mentioned earlier, we will be including the webinar recording and the slide deck into the AFP website to allow members to reference those now and in the future. I'd like to take the opportunity of thanking Harvey and Dave for their support today. Excellent content as always. And thank you all again for your time this morning. And as Paul mentioned, we will be running a number of webinars throughout the year. Watch this space. We'll be sharing our next webinar plans with you very shortly. Thank you very much indeed. Have a good day.